Hi there, everyone, and welcome to this month's edition of On Track. It's the 31st of July as I record this, and I'm just back from 10 days on our annual GPS conference where I run a whole lot of sessions to other advisors, including a whole day on the CARE program. We had a great conference, and then a couple of days in Singapore. The conference was in Malaysia. Back last night, incredibly, always thankful when I come back to Australia. Love traveling, but love coming home. Let's get into it. This presentation is monthly and it's designed to be for the clients of McGregor Wealth Management, particularly those using the CARE methodology and the CARE portfolios. For everyone else, you're welcome to tune in, but please get advice before acting on anything we talk about. Today, as usual, I'm going to put everything in context. There's a lot going on in the world. There's been lots of news. I'm going to cover some of that news, put it into context, talk about what the markets are doing, talk about the CARE portfolio returns, and we'll have a look at what they've done for the year to 30th of June in comparison to other funds and the rest of the markets. We'll do an update on the hottest topic, which is inflation and interest rates, also on what's happening with property and shares. But I want to focus this month on our behavior. So that's the things we do, which contributes to most of our long-term investment results. And I've left one of my favorite quotes in from Warren Buffett as we go through volatile markets. Good to remember, be fearful when others are greedy and greedy when others are fearful. And fair to say we've been in mainly fearful times at the moment, but that will flip at some stage. So let's have a look at some of the news and the numbers. We've had some good signs on inflation over the last month, and most of this came out after June 30, so markets are up strongly since June 30 as well. But you know, the number that came out in Australia last week for the last quarter is 0.8. Now, if you multiply 0.8 by 4, you get 3.2. Not saying that's what we're heading for, but it's a good direction. You can see inflation after being stubborn. That's the quarterly numbers on the left for Australia, the chart down the bottom, and being stuck about twos, which is, of course, about a 6% inflation rate. We've now had two rapid drops, and we're looking to be heading in the right direction. In the US, their monthly inflation number that comes out has just been a nice, steady decline, with the last number being 3%. So the markets are now thinking that, you know, inflation's back in the right territory. We've probably won the war on inflation. Too early to declare a complete victory, and how long it takes to get down into that 2 to 3% band remains to be seen, but it's heading in the right direction. In Australia, we held interest rates, the RBA, that was the new governor. So we had a changeover of governor. Looks like a good appointment. We'll see. Obviously, we need the RBA to be very independent of the government, and that Australia's got a good long history of that. So we'll see how that goes. US had one last rate increase. We'll see whether there's one more maybe for them, or that's the last one. And in both Australia and the US, employment numbers continue to be strong. We've still got fairly low unemployment. There's been a slight increase, but not what you would anticipate with interest rates going up. And part of that is interest rates are probably just getting back into a new normal. As much as we're thinking they're high, they're really just back to where they were pre-COVID, and I'll spend a bit of time on that. Let's have a look at the rates. RBA cash rate steady at 4.1, 90-day bank bills, which is the equivalent of about a 3-month term deposit, about 4.2%. 10-year government bond yields are steadying in that high threes at the moment, 3.97 in Australia. Aussie dollar fairly steady. As I said, Aussie CPI is coming down, so the current annual rate's about 5.4, but if you annualize the last quarter, it's more like in the 3s to 4s. US inflation is at 3%. The cheapest mortgage rate I can see when I scan all the various mortgage sites, about 5.59. Macquarie's lowest variable is 5.89. Most numbers we're seeing from clients have a 6 in front of it. If you're about 6.3 or above, you should be looking to see whether you can get a better deal. Yell out if you want some help with that. And term deposits still extremely healthy, although I note a slight drop from our friends at Macquarie, whose 1-year rate is currently 4.95. We note that a lot of our clients are getting less than that, but generally they just have to say to the bank, hey, I can get 4.95 from Macquarie, my advisor tells me, and the bank will match it. Don't love the way Australian banks do that with mortgages and term deposits, because they're basically happy to thieve from us until we push them a bit harder. So don't be afraid to renegotiate. Now, the last news point there is what I'm going to unpack in the next few months, not so much today, but AI, or artificial intelligence, is all the rage across the investment world. And the Magnificent Seven, which is Google, Microsoft, and a few others, which I'll touch on, are all up very strongly in the last year, up around 48, 50%. And that may be the start of the next bull market being influenced by AI, not just for the revenues that AI creates for tech companies, but for the productivity savings that flow to everyday companies. Let's get into some of the themes. Firstly, the care portfolios to the end of June. So this is the end of the financial year, 2023. It was a good year. The numbers are high. You can see our moderate portfolio at about 8.29%, the core balance at about 10.9, the core growth 11.7, and the high growth at about 12.43. These are very good numbers. Now, they were off the back of a lower return across the market to 2022, so it partly evens out. But when you look at the 3 and the 5 years, they're in a decent zone. Now, 5 years takes into account COVID, so those numbers are slightly under the long-term averages. Next February, care will hit 10 years, so we'll be able to show 10 years worth of data. And the interesting portfolio is right down the bottom there, our Genuine Edge portfolio, where we do have an exposure to robotics and automation, as well as high growth areas like India, global healthcare, and small caps, designed for our younger portfolios and those who probably have an aggressive stance with some of their portfolio where they've got more than they need. That's doing a really good job of achieving above average returns. It will have high volatility. So our market view, we haven't changed. It's still slightly above average. We've got fair value in the Aussie market in the 7.2 to 7.3 range. I note yesterday we're nudging up close to 7.5. That's been off the back of better than expected inflation numbers. Now, as we get better than expected inflation numbers, that will mean interest rates may steady or drop, and that increases the valuations of shares. So even though we say that's a little bit above value, a reassessment of that happens all the time. So we could very well see those get stronger, although we don't expect it to be a runaway, but solid investment returns across the board. How does it compare? So from an article in the Fin Review, on the left, you can see the top performing growth funds in Australia, and they start at the bottom at 9.7. I should point out that most of the industry super funds, including Australian Super, etc., printed numbers in the 8, partly because they don't necessarily mark to market their unlisted investments, of which they have a lot. So they didn't mark them down the year before. They had to mark them down somewhat this year, so that's held them back a bit. So 12 at the top there, but how does that compare? Well, the Care Growth Fund over that last year was 11.75. So we'd have been firmly at the top of the table, like for like, and very happy with those results. The Care Growth Profile, which is where most of our clients are, although we've got clients in the balanced and the high growth, which have both done very well as well. You can see over the last 7 years, it's number 3 in the Lonsec survey. Now, we don't pay to be in that survey. We'd rather spend our money on looking after the portfolio than advertising it externally. But we put ourselves in there every month just to benchmark where we're at. And over 1 year, about number 6, 7 years, number 3. So very happy with that. And just to highlight the difference between the top and the bottom over 7 years. So we're sitting about 7.6. If you go down to some of the ones around the bottom, they're in the 4s, so 3% difference. Now, you're going to hear me talk about returns that investors get compared to investments, but it's very easy for investors to lag the markets by 3%, which makes a massive difference to the long-term goals. Our goals for our clients are to achieve above average performance, just above average, not greatly above average, at below average costs, so that our clients have confidence and achieve above average returns compared to other investors, which I'll talk about. And that means we can plan and achieve the long-term goals. So a tick for 2022 and also for the last 7 years where the numbers are in line with what we would plan. So all of that said with this news framework. So we get news and it's either good news or bad news, and it's either a big surprise or it's expected. And expected news doesn't change the market much, that bottom half, the green. Big surprises that are good, markets go up. Big surprises that are down, markets go down. The only real emerging news that affected markets this month, one was inflation was better than expected. So a little bit of a surprise. better than expected. So markets went up, and you'll see the charts down the bottom here. This is for July. So this is after the June numbers have come in. The market's up from about 7.2 up to just over 7.4 in Australia and in the US. The bottom there was about 4.4 and up to about 4.550. So not crazy, which is good. We don't like crazy markets. There's more room for errors from everyone, but some good long-term news and a good reward for those that have stuck with their strategies. So what did average people do in the last little while? At our conference, Professor Mark Brimble, who also sits on our investment committee, presented some findings. These aren't fully published yet, from a study they did where they looked at a variety of industry super funds. They got hold of the databases and they looked at what people did on a regular basis. So you can see all these bars are single switches and the blue bars are multiple switches. So you can see what happens, and you'll see this big aberration right in the middle. Guess when that is? That's COVID. So what people did is they sold out after COVID when the market dropped, and then you'll see the higher than average they're getting back in over the coming years. That means they lost money. They didn't even get the returns that the investments got because they got out in a panic and got back in when the markets are up. Now, this is why we focus so much on behavior. And our reminder that the returns that investors get, it's you guys, are not always the same as the investments, because most people don't hang on to it. I've got to say, we've had 100% track record over the COVID period of our clients staying invested. So you guys are not victims of this. But this chart down the bottom, which is the Dalbar study, which has been going on for 30 years, shows the impact of that. You know, if someone had just bought an index fund in the S&P 500, they would have achieved a 10.65% return over the last 30 years. But investors in shares only achieved 7.13% return. That's because they chopped and changed exactly like this chart shows. I keep thinking surely the population gets smarter, but we don't collectively, because we're subject to the same emotions that drive behavior, which is fear, or fear of missing out, fear and greed. So that cost, someone compounding over that time, that's the difference between 100,000 going to $2 million or being at 789. So a massive lifetime difference by getting the behavior right. And then if you get the performance okay, you can really plan for your future. So once again, we talk about the wall of worry, and this is the wall of worry in progress. The market goes through those three broad stages. Most of the time we're in the wall of worry where the market's going up, but occasionally it drops when we've got a bigger worry, fear of global economy worsening, the Greek crisis, falling oil prices, rising oil prices, interest rates tightening, fear of inflation. Eventually markets stop worrying, as we saw in the early 2000s, and we have a boom. Everyone gets greedy, we get this fear of missing out, and the market doubles in under 5 years, sometimes only 2 or 3 years. That's what happened in the 2000s. It was followed by a correction or a crash. That's where we get fear. There's always a rebound after that because it goes too far. But overall, a steady, good 20 years if you didn't do anything silly. Now, we know from my previous slide that most people do silly things during those times. So just the ability to hang on and not do silly things gives us above average returns compared to other investors. Let's have a look at the boring old bond market, and we can see that interest rates on the left-hand side, the Australian bond yields, and you can see this bottom left chart. We're now starting to trade between 3 and 4%. So that's a sign that inflation's steady and interest rates are steadying. And this is really going back to where we were in sort of 2015-16. We had a lower period pre-COVID in the 2 to 3 range, and that's potentially where we land if inflation does come down into that 2 to 3% band, and we may see that happen over the next little while, but certainly no crazy worrying signs from there. The US bond market, much the same. They do have that slight inverted yield curve where there's higher interest rates in the short term. That's normally pretty predictive of an economic slowdown, but that's being taken into account by the market, as we've talked about in the last few months. But steadying rates, good sign, steadying inflation, a good sign of stability, which can allow people and companies to plan and invest, which is good for long-term growth. We've talked pretty much about that. As I said, we've got the market just a little over fair at the moment, so I won't touch in on that. We're well past now the 2020 last drop, which was 36%, which put it at number 5 in the top 9 downturns in Australia since 1890 that have been at more than 20%. So pretty rare. They always recover, and that's the message. Long-term investing wins for the patient. The single issue at the moment, I'm just harping back on COVID just to re-emphasize those results that came from those multiple switching and how a single issue obsession costs people a lot of money, because underneath the bonnet, companies get on with doing what they're doing. They evolve, they get faster, better, stronger, and they innovate. They get smarter and develop solutions to whatever problems society keeps throwing up. And that means they make money, which is why that long-term chart goes up. But we'll always have the short-term volatility. And the higher returns that come from shares are just the reward you get from your patience and hanging on. Look, one of the unsung heroes of modern portfolio theory, and the late Harry Markowitz, who died last year, got a Nobel Prize in the 50s for modern portfolio theory. I'm happy to say most people have never heard of it, but for us investment nerds, it's just the way we put together assets in the right sort of quantity that gets the most return for the least risk for each person's individual risk profile. But one of the unsung heroes of that is what we call rebalancing. So we rebalance portfolios if required monthly. This all happens without you having to do anything. And all the research shows rebalancing adds 0.5 to 1% over the long run, which is a great way for us to well and truly pay for ourselves by getting returns that you wouldn't get when you're managing money yourself. So some of those rebalancings, this was from a presentation we did at the conference, and it talks about some of the moves we've made. But I want to go back to this COVID one because that's our flashback for today. And at the top of the market, we were rebalancing. So what does that mean? That means when the market's up, we were selling a bit of shares, buying a bit of defensive assets. At the bottom of the market, we did the exact opposite. So right when all those people were switching out of shares and into bonds, we were selling some bonds and buying into shares, not in huge quantities, but enough to balance the portfolios back. And then as the markets recovered, we took opportunities to rebalance back in line with those benchmarks. So over that period, even though the market was flat, rebalancing had 3 opportunities to add extra returns, which were quite substantial because of the sheer volatility. There's other things on that where the investment committee is operating. I won't go into those in this forum today, but it's good for you guys to know that the investment committee is making changes, albeit small but tactical decisions as markets present opportunities, which most people think is of problems, but we view them as opportunities. What does that mean? It means for last year, let's have a look at market results to the end of June 23. And keep in mind, I said July is looking like a good month, and assuming it steadies today, July will be another good month. But 14.45% on Aussie shares. Now that was a comeback because of a bad year in 2022. So 3-year average of 11, 5-year average of 7, 10-year back towards that long-term average of 8 or 9. And when you consider for the last 10 years, until the last 18 months, we haven't had any inflation. So inflation plus 6 to 7 is our target for shares, and certainly achieve that over the long run. That means bottom right-hand corner, $10,000 has grown to about 23,000 in the VAS, which is the index, the one that we use. So an extraordinary result. And the yellow there shows the average of all funds in Australian shares. So he's in the index. 90% of the time will beat the average of other funds. And you can see the different returns in our top 10 companies that are held in VS. This is why diversification is so important. We had CSL down 7% last year, BHP up 29%, Woodside Energy up 30%, Westpac 10, Commonwealth Bank 10. So a variety of returns depending on what you're held. And that variety, that put them all together, diversified return of 14%. Same with US shares. It's a pretty spectacular year, 13%, and that's in Aussie dollars. And you look down, this is when I talk about these magnificent 7. So these are the companies that are going to benefit from AI. And you see the big ones here, NVIDIA, up 160%, Meta, which is Facebook, up 100%. But then you see Apple, Microsoft, all up 25%. So this is where the market thinks these companies will have an edge in this artificial intelligence space, which can seem a bit scary, but it's going to provide It's going to provide productivity boosts for most companies as it works its way through. US shares have been spectacular for Australian investors. 10,000 investment 10 years ago. In the index, which is where we invest, about 53,000, once again, well above the average for all funds in that category, well above there. So good long-term returns. Global leaders, so this is the top 100 companies in the world. A lot of overlap between the US shares because a lot of them are US companies, but look at all the IT. This is why it's so important for us Aussies to have US shares, because we just don't have those sectors and we miss out on things like massive health companies, which you'll see with things like Johnson & Johnson, Procter & Gamble and others in there. But we otherwise, Amazon's now rated as consumer discretionary, but it's partially IT. So the top 4 companies in the world, all effectively IT companies that are driving benefit there, and a spectacular year, 24% for the last 12 months. So the big end of town is driving these returns, and we're going to see that emerge as probably the driver of the next growth stage of the market. US small caps, 1 year, good solid returns, 12%, almost in line with their 10-year average of 13% and the long-term historical of about 12%. We know that this is the heart of innovation in the world, US small caps. And small caps aren't that small, by the way. Most of these companies would be at the top of the Australian market, but they're small compared to the Amazons and the Google. And 10 years, when you get a 10-year return of 13%, that causes $10,000 to rise to about $45,000. Now that's ignoring people pulling out dividends and spending. So that's for the reinvestors, but it's a great backdrop, whether you're a growth accumulator investment who's still building your wealth or a retiree. Really good returns. Emerging markets have been the slow coach over the last 10 years, well below their long-term averages. And generally emerging markets outperform in the long run. We believe that will return at some stage, and that's why we keep buying as they're cheaper, and they will eventually recover and post some good returns, but a poor return. And just compare that, 10 years 5.4%, $10,000 grows to $20,000. So over that period of time, but compared to the previous one, US small caps growing to 52,000. So massive difference for long-term returns. But the worst thing in the world is always to throw out the underperformers in the short term, because you'll miss out their recovery as the others inevitably go back again as well. Gold has delivered a solid 7.8% return in the last 10 years, 8% last year. It's come down for the month of June, wandering sideways in July since then. As July comes down, it's often an indicator that risk is coming out of the system. So the markets are comfortable that we don't have this crazy inflation risk. Otherwise, gold would be on the tear. And that's partly why gold went up last year. But always interesting watching gold. Let's talk about property, and our model around property is this boom, bust, boring. We're absolutely in a bit of a boring stage, having had a boom post-COVID. And the markets generally go up over time, but they can have long periods of doing nothing, followed by relatively short periods of rapid growth, followed by a slight downturn and then an upturn. So what's it looking like at the moment? In the last quarter, all green. So 4.5% in Sydney, 2% in Melbourne, Brisbane up 4.1%, Adelaide up 3.3%. Perth up 3.2%, the aggregate of all the capital cities and the Gold Coast. And the Gold Coast numbers are in Brisbane, about 3.6%. So compared to the last 12 months where we saw a little bit of a correction, so that's stagnation in property. Brisbane most notably the highest, but it's all come back pretty much. And except for Perth, where Perth has had good solid growth, which is why it's one of our favourite places for long-term property investors at the moment. So market steadying. Some of the things going on, a good article by CoreLogic during the month, which was, could the peak of interest rates be an end to rising rents? And you kind of hope so for the relief, particularly of young people and those long-term renters. We've seen an explosion of rent, and look at that, from no rent growth throughout the period leading up to COVID and during COVID, and then that annual rental growth going up to 6-7%, and rents up really strongly, about 20% across the last 3 years. Well, that's good news for us as property investors. It's tougher news for the market. And you'll see how that's followed the interest rate increase in orange. As that's gone up, so too has rents. That looks to have been a historical trend, was the point CoreLogic were making. And their point from there is, as rates steady or come down, hopefully that'll lead to potentially more steady property rentals. Now, this is an interesting one plucked from the same report. The monthly investment lending for residential purchases, which absolutely boomed. Look, COVID, remember the bottom of COVID was March, and that was the low out of the last, this data goes back 17 years. That was the low for residential purchases. So these are purchases for houses that people are going to live in. So low, then it boomed. So post-COVID, which was one of the weirdest things predicted by no expert anywhere, property boomed, followed by a bit of a back off like we saw over the last 12 to 18 months. But we're seeing lending rise again. So that should be good news for stabilizing property prices, but we're also seeing more properties come on the market as people decide to test the market and cash out. So not expecting crazy growth there, but reasonably steady. And if interest rates start to fall, that should lay the base for the next period of growth. So interest rates very much fixed. You see the 1, 2, 3, 4, and 5 year fixed rates there all converging around about 6-ish to 6.5%. The standard variable about 6.5. Not a big benefit for fixing unless you thought rates had the risk of going up, or you just needed to budget and lock in your numbers. So always appropriate if you really want to lock in a number to know what it is, but I don't think there's a great benefit of fixing at the moment unless you really need to budget in a number. As I said, the average rate is at July 6.5. You can get rates with closer to 6, so 0.5%, particularly on an $800,000 mortgage is $4,000 a year. It's substantial money. You should be constantly reviewing, renegotiating, and looking at or changing, refinancing if needed. Yell out if you're at the higher end. Please try and negotiate with your bank first. We see that most of them will match, particularly for decent mortgage balances. But worth having a go. Our friends at Performance Property, who provide us incredible property research for our clients who are thinking of buying or selling. This is where they have the property clock at the moment. So you can see a large part of the market is either at the mature end of the cycle, lots in the hold category, like Sunshine Coast, where I'm recording from. Some of them, Sydney has been in that downturn phase, although interesting to note it's been back over the last few months. And you can see down the bottom the period of cycle. So Performance Properties say that the AAA stuff, which is all the blue, will tend to have an upward cycle of about 7 years and a stagnation cycle of about 4 to 7 years. And then the regional stuff might be 5 to 10 for the upward cycle, 5 to 10 for the stagnation cycle. So for clients that are buying at the moment, we're very comfortable in Perth, also around Brisbane and Ipswich, Toowoomba, those sort of places. But it is very specific depending on the purposes we're trying to achieve for our clients. So as always, get advice. That's it for this month. And I'm just going to wrap up as always with the key principles that drive us, that investing is best done as part of a real plan. So you can't pick a good investment strategy till you've got a plan about what you're trying to achieve, which is based on your goals and what's important to you. Then we can design the portfolio exactly to meet those goals, where we take a long-term view, and all the boring stuff that makes up modern monetary theory, modern portfolio theory, and that long-term view. And we can see how much that's paid off over the last 10 years for those that stick with their guns, even through some of the most volatile times that we've experienced. We get access through Index, and you'll see the difference that Index makes compared to most growth managers, although we do target specific managers when there's a good reason to. We're protecting against short-term volatility with reserves for our retirees and dollar cost averaging for our investors that are still working their way towards retirement, and that boring old rebalancing regularly, which adds to returns over time. As always, the reminder, there's only 3 ways to lose money on the share market and not to do them. That's panic and selling when markets are down. That's having to sell because you need the money when markets are down, or not being properly diversified. When we tick off all those 3 things, as we do, and as you've all done well over the last bit, then we don't lose money. We get to benefit from the long-term averages. Thank you for paying attention. If you've got this far, I look forward to catching up with all of you as we go through our review cycle. And until we speak again, Rob McGregor signing out.